Hello and welcome to our investment strategy series. As we look ahead to the third quarter of 2018, the prospect of a trade war is the main concern for investors. Tariffs have serious consequences on economies. We are typically dealing with a negative supply shock here, where output falls while prices rise and monetary policy tightens. Protectionism stifles business confidence, affects corporate margins, and impacts financial conditions. So far, the direct cost of announced tariffs has been modest. However, they could increase if President Trump's focus on bilateral trade deficits leads to additional rounds. Overall, the impact on the other economies has been limited for now. Europe has returned to above-trend growth, with rising employment, resilient confidence, accommodative financial conditions, and recovering trade and investment and solid corporate profitability. The ECB is supportive, even if it has signaled a gradual shift towards a less accommodative policy. As for emerging economies, trade disputes and a stronger dollar have undoubtedly created a challenging setting. But it is mostly the countries with the weakest fundamentals or highest political risk that have been impacted. So, although the global economy continues to grow at an above-trend rate and the world trade metrics remain solid, the prospect of a trade war is growing in importance for investors worldwide. And while we continue to closely monitor this risk, we believe the global trade picture should improve and trade tensions de-escalate.
As the cycle advances, risky assets become increasingly sensitive to macroeconomic and political challenges. Tighter monetary policies lead to rising real rates and a flattening of the yield curve, which indicates slowdowns, raising concerns in the financial markets about a potential recession. This could generate more market volatility in the future. When real rates approach 1%, markets will be less stable and geopolitical dynamics could carry more weight. At the moment, US short-term real rates are at around zero, the yield curve still positive at plus 35 basis points, and the cycle can run a bit longer. This environment of greater geopolitical uncertainty, described by Samy, requires a dynamic approach to managing active risk in our portfolios. We have maintained our equity overweight and revised our regional allocation by reducing the US equities underweight relative to European and emerging equities. We have taken profits on our emerging equities trade and shifted our positioning to neutral, although our long-term positive views remain intact. Emerging market fundamentals are by no means as worrisome as recent market action and sentiment would suggest. And these economies will continue to offer value to selective investors. In currencies, we remain neutral on the dollar. More synchronized growth means less US dollar pressure on emerging markets. Our neutral view on the dollar, the sustained global expansion, and the still young cycle in emerging markets support our emerging fixed income exposure. And as a less accommodative monetary policy environment in Europe nears, we have reduced corporate investment grade in our euro and Swiss franc portfolios in favor of hedge fund exposures. Indeed, managers are now well positioned to benefit from volatility and greater dispersion. The soft patch observed in non-US economies in early 2018 has proven temporary. Therefore, we maintain our pro-growth positioning, favor corporate over sovereign risk, and continue to seek exposure to asymmetric trades. We will monitor risk very carefully in light of rising uncertainty, adjust our tactical positioning when needed, and keep you regularly informed. Thank you very much for watching.